All right, on to our next video here, intro to stock index futures. Now, futures markets, you can trade all kind of different products from different kind of commodities, grains, meat, dairy products, things like that. For the purpose of the intro to futures course, we are going to only discuss the micro equity futures. And it's going to be the main four here that we're going to discuss: the micro ES, which is the new small version of super micro version of the S&P 500, micro NQ, which is the small futures contracts for NASDAQ, micro YM is going to be for Dow futures, and then micro M2K is going to be the small, the micro futures contracts for Russell 2000. These are the four equities, okay, and then we're going to go through that. So let me get this disclosure thing out the way. You guys can pause this, read this, or read the disclosures down in the bottom of the rest of our videos. So let's get it going. So futures trade in contracts, okay? Stocks trade in shares, Forex trade in units. Actually, they then break down into what's called pips, but the thing is that they still are a unit, okay? Options trade in contracts. Same as futures, they trade in single contracts. The difference between the options contracts and the futures contracts is an option, when you're buying one contract of an option, you're buying or selling the right to, if it's for stocks, to buy or sell in the future 100 shares of that stock. And if you're doing it in the futures worlds, because there's options in futures and options in stocks, then it actually is a derivative again of just one futures contract. So same thing in futures, they trade in single contracts. Okay, so I want to just get through the basics here. Let's get going. Futures contract structure, it's one single contract, like I said. Now you can buy or sell based on the direction that you believe that market's going to go. You can buy or sell one contract or zillions of contracts if you have the money. We're going to always talk about one. And that one single contract is accumulated as the point value, okay? And then in tick values, and then when you combine the points plus the ticks together, they equal a dollar value, okay? And we're going to break that down in each four of the categories that I mentioned with the different micro futures next. But micro futures, they launched actually in 2019, so congratulations to a lot of the recent traders here. A lot of people joke around and call them COVID traders, things like that. It's not, necessarily funny, but yes, all the professionals I've been dealing with in the last 10 years, all the different platforms and brokers and the guys at the top that I talk to have confirmed that yes, in this last year, a lot of people have come to the business, to the market, whether it's, job changes, just looking for new opportunities and things like that. And it's been great for everybody. I think there's been a lot of success in the newcomers to the market. So congrats if you're a new person. But another cool light is that, micro futures are new in the industry. They've launched since May of 2019. They've been around just very freshly, and didn't exist when I started trading. I had to deal with E-mini contracts, which were, as it says here, 10 times the value of what these micros are. So you just took more leverage, more emotion to trade it, and things like that. Now one could argue that you trade emotionless when you're very confident in your trading, and yes, I agree that does happen. You end up becoming more confident in your plan. Anxiety and emotion becomes less. But however, it's still involved because it's dealing with your money. It's dealing with end of the day, your account. So when you have the opportunity now in the micro futures to deal with just 1/10 of the size. Not discounting sim trading, because sim trading is something we're going to be required to do when you get your new strategies and you put them together, and you have the opportunity to use technology to put down a sim trade and do a series of trades, several dozen of them, journal them, and then you can go into micros where you actually get to put a little bit of skin in the game before you can graduate into multiplying micros into more leverage, or just go into the minis, or maybe go into like one of the combines that we talk about that can help you trade more money, and that way you can trade at bigger contract sizes and just get to your goals daily a little quicker, okay? So, but the cool thing about the micro futures is that it's there. It's a good medium between sim trading, then getting your real skin in the game with smaller amount sizes that a lot more people have available now. because the fact that since 1997, where the E-minis got launched, they just become very expensive. So the size of the E-mini contracts, again, that they were launched back then, they've just become their notional values because the markets go up and up and up. It just costs a lot more money to trade and a lot more leverage and stuff, so it becomes expensive to trade for most people. So sticking with the micros here, we're going to just understand the markets at, again, like I said, it's small skin in the game. And then if you get this down, all the other markets will make sense as far as the different commodities and stuff that exist out there. You'll start understanding, oh, okay, this is the futures market. This is why it's different than stocks. This is why it's different than Forex and all this. And then you'll slowly see by yourself. Don't let me be the one to tell you. See for yourself. Don't take my word for it that futures are probably one of the best things you could be trading. Okay, so let's talk about the micro ES, which is the symbol for it is going to be MES. It trades in the points of $5 a point. Each point has 4 ticks. Okay, you're going to be familiar with this for you newcomers. Be patient about it. You'll get this down once you get it down. It's so simple. For you pros, you could skip through this stuff. This is a foundation course for the guys and gals that want to learn. So please excuse yourself. Again, they trade in points. Each point has 4 ticks. If one point is $1, then divided by 4 ticks is every quarter-cent move. Hold on 1 second here. Sorry about that. So yeah, again, for every 1 point that the micro ES moves, that's equivalent to $5. So if you divide that into 4 ticks, that takes 4 to equal 1 point, then it's $1.25 per tick. So it's going to take 4 of those ticks, like 25-cent quarters, to make a $5 profit or loss. All right, so on this example, it's just a very small example. It's like a scalp, but basically, if MES is at 38.4150 and we're long one contract, our thought is this is going to go up. We go long one contract, and we just have a 1-point target. It's a quick scalp. Scalping just means really quick, 2-second, 3-second trade, get in and out. We take 1 point. That's basically $5 that you gain. And gain is for closed trades. If you don't close the position, just like stocks or anything else, it's not realized yet in your account, so it's considered an unrealized gain. Okay, so the next thing we have is the micro NQ, and so the symbol for that is going to be MNQ. All the bigger ticks symbols for these is just without the M. M is for the micro, and then after that it's just be NQ. So it also does trade in points. Each point does have 4 ticks. And so each point is $2 for NASDAQ, for the micro NASDAQ. And because it takes 4 ticks to get to 1 point, each tick is 50 cents. Okay, we'll give another example here. If MNQ, micro NQ, is at 13.39825, we sold 1 contract. We think this thing is going to go down. And our target is 13.378.25. That is 20 points. So we would make a gain at the close of this position if we get to that target of $40. Next is the MicroYM, and that is basically the Dow futures. The Dow doesn't really trade. It's the only one that's a little bit oddball. It just trades in actual each tick or each movement. It's not considered a tick value. It's just a point. So I'll show you guys in the next screen a quick example. It will make more sense. And then again, of course, experience just gets you to understand it a couple of times, and you'll know. So each little move it makes, a point, is 50 cents in the micro world, because the bigger contract, the mini Dow, it's $5 for every 1 point move that the Dow makes. So you're on those days where if you're new here and you used to sit back and hear on the news, and Dow just went down 400 points just like that. If you were trading the mini version and not the micro, that's 400 times $5. That's a really, really big move, right? It's like $2,000. If you were doing it here in the micros, and just do the math, 400 points times 50 cents. So still a lot of money when there's those big moves in the Dow, if you're trading the micros, okay? And an example here would be if the Dow is at 30,936 and you bought 1 contract long with a target of 31,056, which is equivalent to 120 points. If you got to that, you made 60 bucks. The Micro Russell, and excuse the typo there, Micro Russell 2000, the symbol for that is M2K. And this trades in points of 10 ticks. So it takes, each point is $5. And then it takes 10 of those 50-cent ticks to make the 1 point value of $5. So for every little tiny 1/10 of a point it moves, it's giving you 50 cents profit or loss until you close your position. An example of that here would be if you have the 2162.4 price and you bought long here with a target of 2166 even. That's a total of 3.60 points. So it's an $18 gain when closed, when that target is hit. Okay. Futures contracts, they expire. Okay. They're not like stocks where you buy it and you hold it, and whether it makes money or not, you just hang on to it with dear life and you own that paper. With futures, if you, generally most people do just only, short-term trade these things. But if you were going to hold this thing, as a swing trade position, which means anything over a day up to a few weeks or whatever, equity futures, they do expire every 3 months. Okay. Now there is stuff out there again, guys, and we're not going to go too far into it, that expire monthly. There's stuff that expire about 5 times a year. These future markets, can keep it real simple, they expire in every quarter, March, June, September, December. They go by funny months as far as the letters that don't make sense relative to the month. It's just how it is. The exchange made these up a long time ago, which is those letters down here you see, HMUZ. They're all cash settled, or they'll roll your contracts over if you got caught up in one. But brokers are smart these days, and they usually, I want to say, don't take my word for it, protect their clients by not letting you get caught up in any like rollover, getting stuck in a contract. Okay, it's very rare, but it could happen. It's your responsibility to be aware of this stuff. So. And how we put those together on charts is, for example, ES, in some broker platforms, I have it spaced there as an example for you to see. MES being the ticker, H, let's say, standing for this current month that I recorded this March, 2-1 for the year. Some brokers, so it'll look like that MES H21 altogether, and that's what brings up the micro ES charts. Real simple. Don't let this stress you out if you're new. This is nothing. And again, most trading platforms help you come up with it as you're typing it. MES H2021, some platforms want you to type the whole year. So there's little variances between broker platforms and stuff, but it's very little, minuscule. And again, the platforms themselves, they help you come up with all that stuff. They're not going to scare you off, trust me. Chicago Mercantile Exchange is where everything is centralized from. They are pretty much... this is where we trade all the commodities trade through. It's not like Wall Street in New York. All commodities trade through the Chicago Mercantile Exchange. So we're running off their central time is their start and close. We'll go through all that later on. So again, what are futures? To recap a little bit here, they are derivative markets. Okay, like I said, it's a leveraged product. They're derived off of the actual indexes, off of what's available in Wall Street and stuff like that. And pretty much contract prices, they're slightly different because of that, because this is a future market. They're forecasted a bit into the future. Therefore, there's a slight difference from that, but they carry most of the weight, you'll see, because this is almost a 24-hour market, that the markets, when they open and they're gapping up and down, it's also because of what these markets have performed during what's called the Globex session. Used by hedging by producers a lot. Okay, this is why these markets exist. They've been around since the Egyptian times. Okay, producers want to lock in profits on their crops, right? So if they see maybe an unknown, there could be an unknown bad freeze coming in the Midwest on cattle, and they might lose a lot of cattle, or grains can get frozen over. There might be a storm and flood them out, etc. Just in case of any of these unknowns, right, that can happen. When they see prices at a price that they're willing to lock in, they will use the futures markets to hedge their crop, lock in a price, so that way if there's any kind of downfall, it's like their insurance. So producers use a lot of these things to hedge, okay? So, and therefore that's why they expire too. So that, just like options, they do expire, but options decay. So anybody here that has options experience and background, you understand that, your options, their contracts expire too, but also as that time nears, they're decaying. We don't have that here in the options market. Okay, and just getting a little bit deeper into that then. So look, the brokers, they'll make it easier for you to get around. There's a lot of these platforms out there. I have over a decade of experience, and I have some of my best experience from NinjaTrader platform, TradingView, and TradeStation. But again, just to let you guys know, the best knowledge comes from experience. And so when you get some experience under your belt, it's going to be easier to understand some of the things I'm talking about, or some of the things some of the other guys out there have been talking about. But you know, just like anything else, right? So that's about it. Futures trading, oh, by the way, does use margins. Okay, so we're trading with margin. You'll hear a lot of that. That's different from stocks, and people say, be careful. What is that? You know, be careful. Don't trade that stuff. You can blow out your account real quick. Yes, futures trades with margins. Okay, and who dictates that is basically the exchanges. I'll show you guys some reference points here before we leave. The CME Group, the Chicago Mercantile Exchange, sets standard margin rates. Okay, meaning for each contract, you need to have a certain amount in your own account to trade that per one contract. That's kind of like your good faith deposit. Trade that one contract. So you got to make sure that you have enough to offset, because when things get volatile, those margins can fluctuate. So you don't want to over leverage yourself and trade with too much. You'll get what's called a margin call. So it's set by them. Now, however, wholesale brokers, some like the aggressive guys like NinjaTrader and stuff, they have discretion. All brokers have discretion over their requirements. So there's some people out there willing to give you super deep discounts, like $50 micro futures contract margins for day trading, or $500 for the minis. Again, 1/10 of the difference, 10 times the difference. Whereas some brokers are just very strict about that. They feel it's being more professional to just only offer with the margin that the CME Group recommends. So right now with volatility, at the time I record this in the last year with COVID and stuff had all happened and endured here, you know, you've had margins as high as like 15, 16,000 for one E-mini contract, not micros, but you know, where silver right now, they're being pumped up by people. Those margins are pretty high. So when things get volatile, they move a little, but you just got to make sure you understand what margin is, because you're using leverage, and leverage in the wrong hands can be dangerous. But when we're trained up right, you know what you're doing. You're the right people, right team. You have a good strategy plan. Everything's planned out. You have everything ready to go. It's again, you get the best capital efficiency with the proper training knowledge. You can make more for less upfront money. Okay, so it's a good and bad. It's a pro and con to everything, but it's about what you know and how you use it. That's gonna get you to that next level, and you don't have to worry about some of the things, the kind of like that hype stuff that's out there that exists about these things. So for more information about the CME Group, you can go to cmegroup.com. They got a ton of information there about who they are, what their marketplace is, what they do, and all the products, contract expiration, things like that. You could additionally go to barchart.com. They're a private company. They are large. I personally have been on there a couple of years, putting on some publications. I've been a little bit dry on doing that lately, because that's when I was doing a lot more spreads and hedging with commodities. I'm more into intraday trading, getting people up into day trading, and getting you guys even maybe potentially qualified to consider trading one of these combines, which is like trading for a hedge fund. If you qualify and prove that you can make enough money and not lose at the same time too much money, to keep a good statistical base and get yourself qualified to trade other people's money. So it's, you know, it's a good time right now to get involved. And so therefore with that, I'm a little bit less active on Barchart as far as my commentating. Because I'm intraday trading a lot too, but it's a good source for you to get out there and get a bunch of free information on. You can get contract expirations, market heat maps, and things like that, all about the futures markets, all completely for free, and a bunch of commentating and stuff like that. Keep the information limited. Don't get yourself too much information, too many gurus, too many YouTube channel subscriptions. Keep it really light, keep it very simple, and jump on the horse. Get yourself there, because I'm telling you, one of the worst things I ever did in my trading career was I stalled too much with too much information overload. And I spent more money to learn than I've lost in the markets, but it took me too long to do that, and I killed a lot of time. And there's no need, okay? The more you do this thing, It's actually easier than you think, but again, I gotta be careful how I word that. Anyways, guys, well, we'll see you in the next video here for part of the Futures Foundation course on Viper Futures. Thanks.